In June 1974, two men flew to Riyadh for a series of meetings that would quietly reshape the global financial order for the next 50 years. Henry Kissinger, Treasury Secretary William Simon, King Faisal of Saudi Arabia. No press conference, no formal treaty ratified by any legislature, no dramatic announcement of any kind. What emerged from those meetings was an arrangement so elegant and so consequential that it is still governing how every barrel of oil in the world is priced today. Saudi Arabia would sell its oil exclusively in US dollars. It would invest the surplus proceeds into US Treasury bonds. In exchange, the United States would provide military protection, weapons, and the security guarantees that a young Gulf monarchy needed to survive in a dangerous neighborhood. The petrodollar was born, not with a signature, with a handshake. And for 52 years, that handshake held. Then, on March 14, 2026, a senior Iranian official told CNN something that nobody in the mainstream financial press has fully processed yet. Iran was considering allowing a limited number of oil tankers through the Strait of Hormuz on one condition. The cargo had to be settled in Chinese yuan, not dollars. That sentence, 11 words, is the most consequential thing said about the global financial order since Nixon suspended dollar-gold convertibility in 1971. Because what Iran just offered the world is not just a transit arrangement. It is an alternative to the system that has governed energy trade for more than half a century. And the infrastructure to make that alternative real already exists. To understand why this moment matters and why it has been so consistently underreported, you have to understand what the petrodollar system actually was, not the myth, the mechanism. By 1971, the United States was in crisis. Nixon had just suspended dollar convertibility to gold, ending the Bretton Woods arrangement that had governed the post-war financial system. The dollar was depreciating. Inflation was rising. And then, in 1973, OPEC imposed an oil embargo that quadrupled global oil prices and sent the American economy into its worst recession in decades. The United States faced a structural problem with no obvious solution. Oil-producing countries were accumulating enormous financial surpluses, petrodollars that could theoretically be used in ways that threatened American interests, and the dollar, freshly detached from gold, needed a new anchor. Kissinger's solution was as audacious as it was simple. Instead of trying to reduce Gulf financial power, the United States would capture it. The arrangement worked on three levels simultaneously. First, oil, the world's most essential commodity, would be priced and settled exclusively in dollars. This meant that every country on Earth, regardless of its relationship with the United States, needed to hold dollars to buy energy. The demand for dollars became structural, permanent, self-reinforcing. Second, Saudi Arabia's surplus petrodollars would be recycled back into US Treasury bonds. This gave the United States a perpetual buyer for its government debt, allowing Washington to run deficits that would otherwise be unsustainable. The Saudis were effectively financing American spending, and doing so willingly, because they were earning returns and receiving security guarantees in exchange. Third, the dollar's role in oil trade reinforced its role as the global reserve currency, which reinforced its role in trade settlement, which reinforced its role in debt markets, which reinforced its role in oil trade. A self-sustaining loop, a financial perpetual motion machine. And what nobody is mentioning is the coercive dimension of this arrangement that rarely appears in the official history. U.S. diplomats had made the underlying logic explicit to Gulf producers. You can charge what you want for oil, but the proceeds must stay in dollar assets. And countries that tried to price oil in other currencies, Iraq under Saddam Hussein switched to euros in 2000, Libya under Gaddafi was proposing a gold dinar, found themselves facing American military action within years. The petrodollar was not just an economic arrangement. It was backed by the credible threat of force. That is how it held for 52 years. Now let's look at what has changed. Because what has changed is not a single dramatic rupture. It is a slow structural dismantling, accelerated sharply by the events of 2026. The first crack appeared not in 2026, but in 2022. When Russia invaded Ukraine, the United States responded by freezing $300 billion in Russian central bank reserves, dollar assets held in Western financial institutions. The message was clear. Dollar assets held abroad are not unconditionally yours. They can be seized. Every central bank in the world received that message, and every central bank that had any reason to worry about its relationship with Washington began quietly reassessing its reserve strategy. What's particularly revealing is what happened to gold. In June 2026, the European Central Bank confirmed that gold had overtaken US Treasuries as the largest reserve asset held by foreign central banks globally. Gold, 27% of global reserves. Treasuries, 22%. The first time in the post-Bretton Woods era that U.S. government debt had fallen below gold in foreign central bank portfolios. That is not a coincidence. That is the collective judgment of the world's central banks, expressed in allocation decisions about the reliability of dollar assets as a store of value. The second crack was the infrastructure. China has spent a decade building the plumbing for a parallel financial system, and in 2026, that plumbing is operational. Saudi Arabia joined Project mBridge, the cross-border central bank digital currency platform, built by the People's Bank of China, the Hong Kong Monetary Authority, and the central banks of the UAE, Thailand, and now Saudi Arabia. The platform has processed $55 billion in transactions. 95% of those transactions were in digital yuan. It operates independently of SWIFT and independently of US dollar correspondent banking. In 2023, Saudi Arabia and China signed a $7 billion currency swap agreement, allowing direct Riyal-yuan exchange without dollar intermediation. Saudi Arabia participated in yuan-denominated futures contracts on the Shanghai Petroleum and Natural Gas Exchange. The technical infrastructure for Saudi Arabia to price and settle oil in yuan, the thing that would structurally dismantle the petrodollar, was quietly assembled over 3 years. What Saudi Arabia has not done, and this distinction is critical, is make a permanent public commitment to yuan pricing. Saudi Arabia's central bank reaffirmed its dollar peg in February 2026. The kingdom still holds the majority of its sovereign wealth in dollar assets. The structural inertia of 52 years does not disappear overnight. But here is what the data suggests about Saudi Arabia's actual position. Saudi Arabia is not choosing between the dollar and the yuan. Saudi Arabia is building optionality. The ability to price in either direction depending on who is offering the better security arrangement. And that brings us back to March 14, 2026. Iran's offer Hormuz passage in exchange for yuan settlement was directed not primarily at Saudi Arabia. It was directed at the countries that need to buy oil and cannot afford to have the strait closed. China, India, South Korea, Japan. For China, the offer was almost redundant. China has been settling oil purchases from Iran in yuan for years, using mid-sized Chinese banks with limited SWIFT connectivity to route around U.S. sanctions. Chinese entities facilitated the vast majority of Iran's oil exports in non-dollar currencies throughout the sanctions period. But for India and South Korea, countries that maintain significant economic relationships with both the United States and China, Iran's yuan condition created a genuine dilemma. Do you pay the yuan toll to get your oil through? Or do you comply with the American position and wait? India's response has been characteristically pragmatic. India has been expanding its use of rupee and dirham settlement for oil purchases throughout 2025 and 2026. It is not committing to yuan, but it is actively building alternatives to dollar settlement. The direction of travel is unmistakable. Let's take a step back because this is the moment to ask the real question. The petrodollar system was never a formal treaty. It was never ratified by any legislature. It was a handshake, maintained by mutual interest and the credible threat of American military power. Both of those pillars are weakening simultaneously. The mutual interest is weakening because Saudi Arabia's security relationship with the United States has deteriorated under MBS. The U.S. withdrew troops from Saudi Arabia. It fumbled its response to the 2019 Aramco drone attack. It failed to prevent Iranian strikes on Ras Tanura in March 2026. The security guarantee, the core of the 1974 arrangement, is no longer delivering what it promised, and the credible threat is weakening because the alternative infrastructure now exists. In 1974, there was no alternative. Oil had to be priced in dollars because there was no other functional settlement system at global scale. Today, mBridge is operational. CIPS processed $245 trillion in transactions in 2025. Yuan swap lines connect China to dozens of central banks. The monopoly is broken, not dramatically, not all at once, but structurally, irreversibly. So what comes next? The first scenario is accelerated fragmentation. The Hormuz crisis forces a permanent bifurcation in global oil settlement. China and its trading partners settle in yuan through Bridge and SIPs. Western-aligned buyers continue settling in dollars. The petrodollar doesn't end. It becomes one of two systems, rather than the only system. American sanctions power is permanently reduced because the dollar network can no longer claim universality. The second scenario is Saudi consolidation around the dollar. Saudi Arabia, calculating that its long-term financial interests are still best served by dollar-denominated assets, and that no alternative security guarantor can replace American capability, reaffirms the petrodollar arrangement. It deepens its participation in bridge as a hedge, but doesn't convert its sovereign wealth or its primary oil pricing to yuan. The system bends, but doesn't break. The third scenario, and the one that history most consistently produces in moments of structural transition, is managed ambiguity. Saudi Arabia maintains dollar pricing for Western buyers and gradually introduces yuan settlement for Chinese buyers. Two prices, two systems, running in parallel. Officially, the petrodollar is intact. Structurally, it has been divided. The ambiguity is maintained because resolving it in either direction carries costs that no party currently wants to pay. History shows that managed ambiguity is the most common outcome in the early stages of reserve currency transitions. The pound sterling maintained its reserve status on paper for decades after British economic power had begun to decline. What ends reserve currency status is not a dramatic announcement. It is the slow accumulation of alternatives, until one day the alternatives are the default, and the original system is the legacy. Honestly, which scenario do you think is most likely? And is the petrodollar already broken in any meaningful sense, or is it simply being renegotiated? Tell me in the comments. I read every single one. So let me bring this together. In 1974, Henry Kissinger flew to Riyadh and built a system that would guarantee dollar dominance for half a century. Oil in dollars, petrodollars recycled into treasuries, security guarantees in exchange for financial cooperation. In March 2026, Iran offered to reopen the world's most important energy choke point on one condition: pay in yuan. Between those two moments, something structural has changed. Saudi Arabia joined Bridge. China settled $55 billion in digital yuan through the platform. Foreign central banks moved gold above US Treasuries for the first time since Bretton Woods. The security guarantee that anchored the 1974 arrangement failed to prevent strikes on Ras Tanura. The petrodollar is not dead. It is the largest, most liquid, most deeply embedded financial system in history, and it will not be replaced overnight. But for the first time in 52 years, it is no longer the only option. And in global finance, as in geopolitics, the moment something becomes optional is the moment its leverage begins to erode. Tell me in the comments, do you think the petrodollar survives this decade? And which country is positioning itself best for whatever comes after? Like this video if the analysis was useful. Subscribe if you want to understand not just what is happening, but why it keeps happening and what comes next. Stay sharp. The next shift is already in motion.